Participants in the agricultural commodities markets are quite diverse, from farmers and food manufacturers to hedge funds and individual investors, each with their own rationale for transacting in these products. Well, let's start with hedgers. Hedgers are participants with real exposure to commodity prices in their day-to-day business, where they use futures contracts to try and mitigate risk. These may include farmers and producers, food and beverage companies, or import-export firms. For example, let's say a wheat farmer is worried that prices will fall before harvest time. By selling a futures contract now, they can lock in a price and potentially protect their income. Meanwhile, big food manufacturers like cereal makers or soft drink producers may buy futures to secure prices for ingredients like corn syrup or sugar to help stabilize input costs and protect their profit margins. Also, in global trade, companies can use commodity contracts to manage the risk of fluctuating prices across different regions and currencies when performing import-export activities. These participants are generally using the market more to reduce uncertainty in their operations than make a profit from trading. Well, let's now take a look at market speculators. Speculators are typically traders whose objectives are to profit from price movements, and they don't necessarily have any interest in owning the physical commodity. These types of participants may include institutional investors and hedge funds, retail traders and individual investors, as well as commodity trading advisors or CTAs. Institutional investors and hedge funds, for example, commonly use advanced trading strategies, algorithms, and economic outlooks to try to profit from short or long-term price trends. They often trade in high volume and add liquidity to the markets. Also, retail traders and individual investors may take advantage of trading platforms like interactive brokers, where individuals can trade futures and commodity-related exchange-traded funds or ETFs. Some of these participants may be day traders, while others may hold positions for longer periods based on, say, their macroeconomic views. Meanwhile, CTAs are professionals who manage client money using strategies focused on futures and options, including agricultural markets. Overall, speculators play a vital role in the markets by adding liquidity and helping to provide more efficient functioning, even though they don't produce or use the commodities themselves. Other types of participants in the agricultural commodities markets may also include central banks and governments who may monitor or even intervene in agricultural markets for economic stability or for food security reasons, especially in developing countries. There are also thematic funds, such as certain ETFs or mutual funds or ESG-related funds, that may offer exposure to agricultural commodities without directly trading in futures. So, whether it's for managing business risks, building a diversified portfolio, or simply making a profit from short-term trends, agricultural commodities markets attract a wide variety of participants with a scope that extends well beyond just farmers and food companies. In fact, agricultural commodities are a global asset class involving a wide cast of players, from institutional traders to individual investors. Understanding who's in the market and why can inject valuable insight into the price behavior and trading volume. In our next lesson, we'll talk about certain of the more major risks traders and investors may face when buying or selling agricultural commodities. Come on back.